Welcome to Clear Money Talk, where we turn complex financial topics into clear conversations.
I'm Tyler Andrews.
And I'm Tim Clairmont. Let's get started.
All right. You ready for the topic today?
Yeah, what do we got today? What's going on?
Are you chasing returns or building real wealth?
Oof, are you chasing returns or building real wealth? Okay, that's good. That's
Heavy.
Yeah, it's heavy. Yeah, it is.
A lot of investors will be chasing scoreboard and missing out on strategy. And that is something that we deal with on a daily basis.
Yeah.
Strategy is, what is your strategy? What are you shooting for? What's your North Star? But a lot of the times we get hung up on rate of return. We get people walking in every day focusing on rate of return this, rate of return that. And all that is a critical element to financial planning and investing. It's not everything. And I thought this would be a great topic to talk about differences between rate of return and actually having a plan, scenarios that we've seen people have success with these things, and just kind of go from there.
Yeah, no, I think that's totally smart. Makes perfect sense. And I'm really glad we're really hitting this nail right on the head, because it's something that I think too many times gets skirted around. Like, I get at the end of the day, rate of return matters. And you might be a do-it-yourselfer following along our Clear Money Talk podcast and thinking, I'm just going to listen to this information and just go figure it out on my own. Odds are you're spending 95% or more of your time thinking about your investment portfolio, focusing on rate of return. And the reality is, while that is a very important component, as Tyler said, there is so much more that goes into building real wealth. Real wealth is about how much money you control in your life. It's really more about your net worth. So your income stream that's going to be coming in, what are you doing with that to use it effectively? How are you building equity in your assets? In other words, think about your real estate. If you own a home, then there's a value of the home and there's how much you owe on it. The difference is your equity. That's part of your net worth. That's how much that's your wealth. That's part of your wealth. How large is your portfolio in terms of dollars? How much do you get to keep related to taxes? You might be thinking about fees associated with investments, critical component, but what about taxes, and how are you factoring your tax management of your various investment decisions? How many times do you find yourself making investment decisions based on your tax situation rather than the wisdom of being in those particular investment choices? There's a lot that goes into building real wealth, and I think this is an excellent question. So I'm excited to explore it with you, and I'm sure you've got some structure that we might be able to follow as we have this conversation.
Yeah,
I appreciate that you do.
Of course. I think a lot can even be said with income. It's like a lot of people will say it's not about how much you make, it's about how much you keep. Right? Taxes and how much you're saving and investing and all these other factors. So we'll be excited to talk more about this and go from there. So the first bullet point, if you will, Tim, was when beating the market becomes a distraction. So, trying to outpace the market can oftentimes lead to emotional decisions, which oftentimes lead to worse results than if you had just bought something and held on to it, or followed a script, if you will. And that's the emotional side of this, trying to outpace and beat the market, often leads investors to do the opposite of what you want to do, which is buy high and sell low. You want to be buying low and selling high. And when you're trying to time things, it's impossible to time things correctly all the time. So,
no, you're spot. I'm just like so excited because you're so it's so spot on.
Oh,
that just happened.
Cool.
Jigs, you owe me a Coke.
Yeah.
Anyway, so it was, when you think about it, I always talk about the two limited resources are your minutes and your dollars. And focusing on the ROI on your dollars is important. And we're always paying attention to that. I mean, that's table stakes. If your financial advisor is not paying attention to the ROI on your money, then I don't even understand why you're working with them, because fundamentally that's something every financial advisor needs to do. But that should only be about 5% of what that advisor does. The other 95% is all the other stuff that helps you build wealth, minimizing taxes, maintaining that allocation, hanging on to your allocation based on your risk tolerance, and customizing that based on where you're at for time before you're planning on touching the money. Because your risk tolerance should change based on your distance to your goals. But the ROI on your minutes, that's something that a lot of people don't give consideration to. And that's one of the things that I find myself saying all the time in a lot of the speeches that I'm giving in various places is it's always about maximizing the ROI on your minutes. We only have so many minutes in the day. And if you're overspending your minutes on focusing on trying to beat the market and eke out an extra 0.5% or 0.25% above market performance, then how valuable are those minutes that you've just spent to get that extra 0.5% or 0.25%? How valuable is your time? And that's one of the biggest keys to successful wealth building. Most people who are extremely wealthy do not waste minutes doing things that they can pay somebody else to do for a lot less money than it costs them in terms of their time. So when you think about the value of your time, that's a huge part of this. I mean, Tyler and I have been studying this for, literally almost 30 years. I started in 1997. It's 2025. I'm recording this, so 28 and a half years. I've been doing this, and Tyler's been doing this for almost a decade.
Hey, don't age me.
Whatever, almost a decade. You're close, bro.
Yeah.
Welcome to. It's gonna happen. You already have a couple people,
close.
your apprentices, you're training. So
That's right.
yeah, that's the way.
Passing the puck.
It's the way it works. Yeah, we want to pay it forward and help other people. But
right.
The point is, you're never going to catch up on the ROI of all those minutes that we've already spent. I mean, we've spent almost 4 decades studying this stuff between the two of us. And when you think about that, how are you going to even begin to try to tap into that knowledge and compete with what we already know from a standpoint of building wealth? The easiest way to do it is to find somebody like us that you resonate with, that you trust, that you are aligned with from a value standpoint, and hire them to do the things that you're either not already familiar with, not already good at, or just don't want to do because it's not the best use of your time and your minutes.
Yeah. I think there's a lot of things we all don't want to do in life.
Yeah, it's true.
We all got the same 24 hours, so it's trying to maximize those minutes to the best of your ability. Things you want to do, things you don't want to do. So back to the meat and potatoes of the topic is, real wealth building is about patience, not luck.
Yeah.
And when it comes to compounding, which compound interest, right, 8th wonder in the world.
Yeah.
And
you remember who said that?
It's Isaac Newton.
Albert Einstein.
One of those smart gentlemen.
I know, smart guy, right? Eighth wonder of the world, compound interest. Very cool. Very good. Now, unless I was misquoting it all these years, which you can correct me and send me an email or call me out if I got that wrong, but I thought it was Albert Einstein.
I'm pretty sure you're correct.
All right.
Yeah. So real wealth building, it's about patience, it's about persistency and not timing things. I mean, I think I've quoted this before in another podcast that we've recorded, Tim, is that you could miss the 10 most important trading days in the open markets and your returns can be cut in half by missing out on those 10 most important days. And why is that important? Well, if you're somebody that's constantly trying to beat the market or trying to time things, we talk about day trading or whatever you want to call it, you could position yourself to be out of the market when you should have been in the market. And although you might win sometimes, you're never going to win all the time. It's never been done. I mean, there's portfolio managers and institutional managers and CFAs, analysts, all these extremely bright professionals that they still can't do it. So what makes you think that you can do it? If you can do it, kudos to you. Would love to know what you're doing. But it's just not the reality of the fact.
Well, and I heard somewhere this statistically, admittedly, I haven't verified the accuracy of this, but it feels true to me. So, I'm happy to repeat it.
Yeah.
In order to successfully outperform the market in tactical investing, which is when you're getting in and out of the market, or getting in and out of particular asset classes or stocks or things of that sort, you have to be right more than 80% of the time. It's not 50-50 kind of situation, more than 80% of the time to consistently outperform the people who just simply ride through, the people who just hang in the market and go through all the good days and all the bad days, and they get those 10 great trading days because fundamentally they're not out. They're never out. It's about time in the market, not timing the market, that generates that kind of return. So if that's in fact true, which you're welcome to verify this on whatever resource you may have, nobody's going to be beating the market and be accurate in these tactical moves more than 80% of the time. I mean, that's literally 4 out of 5 times you're right when you're guessing on the movement of the market. And that's just to break even with the people who don't have to guess at all, that are just riding through. Just never made any sense to me. Now, we do have a handful of clients that like tactical investing, and we have access to some phenomenal tactical investors as institutional money managers that's what they do try to do. And if that's your bag, we'll help you do that. We're not going to judge you and say you can't do that by working with these professionals. But how are you going to try to personally manage your own life, manage your own personal desires, manage your own family, manage your own career, and simultaneously try to compete with some of the world's top institutional money managers on market timing and think that you're going to do a better job? Maybe you are, and maybe you're gifted in this way, but more than likely, you're probably just been lucky a few times. And if you've been lucky a few times, you can be unlucky a few times.
Yeah, well said. I love it's time in the market, not timing the market. It's such a good quote. So accurate. Appreciate you bringing that up.
Yeah.
You know,
Yep.
performance feels good though, right?
It does.
Returns,
We like it. It feels
returns
good.
feel good,
Yeah.
but you know, planning feels better. And I think that's what probably a lot of listeners, a lot of investors are missing is the planning aspect. You know, we've talked about it before in other podcasts. It's kind of like use the analogy of you have a bow and arrow and you're trying to shoot at a target, or you're just shooting arrows into a field. And having a target and shooting the arrows towards that target is important. And that way you're not just having a quiver of arrows and you're shooting them out into nothing. And that's a lot of what people are doing.
Yeah.
Is they're just chasing returns. They don't really have the strategy, the planning behind it. And that is where a lot of people, I think, go wrong with their approach.
I love that analogy, especially as I think about the distance the target is from you changes the way that you shoot the arrow. You see, if you're just shooting the arrow as well as you can, you're just focusing on trying to have the absolute perfectly still aimed bow arrow situation. But what are you aiming at, by the way? You're just trying to have a really nice, fast, far shot. Maybe you're just trying to hit it as far as you can. That's focusing on return on investment. But if you're trying to hit a target, and that target is 100 feet out, you're going to need to go in the air a certain amount in order to have it come down and hit that target just right. You can't just shoot straight because it's too far out. You have to anticipate the movement of the arrow in the air while it's on its way to the target. On the other hand, if that target is 20 feet in front of you, you could shoot it much straighter and it's going to go straight towards the target. You don't need to anticipate that up-down movement, not to mention wind and everything else as the target's further away. All of those elements are similar when it comes to investing for your future. If your target is a long ways away, there are a lot of things that are going to affect that rate of return on your investment portfolio. And there's a lot of variables that will affect your ultimate building of your net worth. As you get closer and closer and closer, there's not as much outside influence that's going to affect your success, but how you shoot that arrow in that final scenario is critical. And that's your, as many refer to it, your retirement red zone, or your period of time when you have to pay attention to what's going on for your lifetime. You're about to transition into no longer working. If you're not going to work anymore, your paycheck stops. How big is your replacement paycheck going to be? How taxable is it going to be? How much do you get to keep after taxes? How long is it going to last? How long are you going to live? And how much leftovers are going to be there for your family when you're done? All of those are questions that we have to have answers for that help you build that target to make sure that you hit it.
Well said. I think what we're all trying to say here is that your financial plan is the real MVP.
There you go.
Anybody can win 1 year, but it's about staying ahead for decades, not just focusing on a year-by-year situation.
Fair.
But can you stay ahead for your entire life? For a lot of people, they're investing for decades on decades on decades, and that's where a solid plan, and sticking to a plan really comes into play.
Fair.
So, yeah.
Good. What else you got? Did we cover it all?
I think we covered most of it.
This could be a tight episode. I feel good about that.
I like it. I mean, we're not trying to dissuade somebody from chasing returns, but have purpose behind those returns and why you're going about that, and understand the greater aspect of how it affects all the different moving parts of that. That was the important part.
Yeah, and if you really, really enjoy trading and investing, and you're getting joy out of spending your time doing this kind of thing, okay, that's different. That's fine if that's really what you enjoy doing. But do you really want to gamble your retirement success on something that you just enjoy doing, like a hobby? My father's a phenomenal fisherman, but he never stopped his career so he could become a full-time fisherman, and I don't think he regrets that. He never relied on fishing to take care of everything in the household. Yeah, we had a lot of fish when we would eat dinner at night sometimes, and so it was nice to have that there. But at the end of the day, a hobby that you really, really love doing, like watching the market or listening to where the market's going or the economy or looking at your rate of return, shouldn't be your plan. And I think Tyler's spot on when it comes to, the plan is the MVP.
I think so. Should we do just the answer?
Sure, hit me.
Okay.
Go for it. I love delegating the just the answer to Tyler.
He does.
So if you only listen to just the answer, you probably hear Tyler all the time. You're like, who's this Tim guy? Because Tyler's like brilliant. I'm just going to listen to Tyler all
Thanks,
the time.
Tim.
He's pretty good. All right, go for it.
All right, let's. It's always good to start with reiterating the topic, which was: are you chasing returns or building wealth? Are you chasing returns or building real wealth? So we talked a lot about how many investors focus on the scorecard, Tim, that they're looking at what are my returns, year to date, last month, year to date, 3-year, 5-year, 10-year. And although returns are very important, they're not everything. So we talked about how planning and have a solid plan in place is the real MVP when it comes to financial planning in general. And we mentioned a quote that said, if you miss the 10 most important trading days in the market, that can cut your returns in more than half, statistically speaking. We talked about how it's about time spent in the market, not timing the market. That's a quote we like to use a lot, but I think it holds true. What else did we talk about?
Yeah, it's good. What we didn't talk about is index funds versus managed funds and some of the elements there, passive investing versus active investing. We did talk about tactical investing versus strategic or buy and hold investing. But I know we've discussed index funds in several of our other shows.
We have a podcast on that.
Yeah,
check that out.
Feel free to check out the podcast if you want to dive deeper into that. We've also got other podcasts on fees that we've explored that more thoroughly. But all of those things factor in. At the end of the day, the analogy, I think, of the bow and arrow is solid. And this is a relatively short episode for the long version. So if you like this topic, you should just listen to the long version as well.
Entire thing.
There you go.
Cool.
All right. You ready to transition? Trivia it is.
I am.
Stump the nerd.
Stump the nerd. Okay. I like the trivia. It ties in well with the podcast topic here. So I'll loop it all back together here momentarily. But Tim, I would like you to answer this question for me.
All right.
Which tree takes the longest to bear fruit after being planted?
Ooh, which tree takes the longest to bear fruit after being planted? I don't know. I'm not a big horticulturist or anything else.
What a word drop right there.
Well, it's like I'm not a plant nerd. Like I'm just a money nerd most of the time, and maybe a little bit on movies and books. So plant nerd stuff.
You want me to give you some options?
Yeah, I think I'm going to need them. I mean, otherwise I would say something dumb like bamboo or something that I know takes forever to grow, and I don't even know if bamboo has any fruit.
I don't think that's fruit.
I mean, don't all trees have some amount of fruit, or do they have nuts? I guess they have nuts or they have fruit, and that's how they procreate. So anyway, whatever.
All right,
so what do you got?
Here are options: mango tree, oak tree, avocado tree, apple tree.
Okay, so the oak tree has nuts, and so I'm not gonna think that I don't think it has fruit unless you're counting the nuts as fruit. So we got apple, avocado, and mango.
That's right.
Those are all fruit-bearing trees. So, and between those three, I think the apples are pretty quick. I feel like the mangoes are kind of quick. I would go with avocado. That's my guess. Avocado.
Yeah, great guess. It is avocado.
There we go. Perhaps I missed my calling.
Bring it all back
Horticulturist it is.
Yeah,
please correlate this.
Avocado trees can take up to 10 years to produce fruit. A good reminder that patience often leads to the best rewards.
Nice.
So with the grander scheme of the podcast topic, are you chasing returns or building real wealth? Sometimes patience is the best virtue that you can have when it comes to investing. Things don't happen magically overnight. Although it might seem that social media and magazines and the television want to tell you that it can, it doesn't. I think patience is the true solution, if you will, to building real wealth that lasts more than a year and can carry on.
That's fair. And as I mentioned earlier in the podcast, the two limited resources being your minutes and your dollars. Maximizing the ROI on your dollars is table stakes for financial advisors. Maximizing the ROI on your minutes is something you need to pay attention to, something we're very conscientious of here. There are two additional resources that can be limited: your energy and your attention. And so when you try to optimize your energy so that you can bring the best version of yourself at all times to get more ROI out of your minutes, I think that's important. But attention, as Tyler just commented on, these various social media sources and news outlets, they will use ROI, return on investment of your dollars, to try to grab your attention and try to have you focus on what they're teaching. Just like right now, we're asking you to give us your attention so that you're listening to the things we're trying to impart upon you. We want you to be wiser after you listen to one of our shows or watch one of our shows on YouTube. And that's our goal. We just want you to be smarter about money. We're trying to teach you something smart about money. But when it comes to attention, if you pay attention to all of those things that are trying to grab you and scare you about rate of return and investments in the markets, it's really easy to get distracted and spend way more of your minutes focusing on the wrong thing instead of focusing on something that will actually build your real wealth.
Well said, well said. And if you need help building a good plan, reach out to us.
That's what we do.
We'd love to hear from you.
We do this for a living, and we are still taking more clients. So feel free to reach out to us. You can catch us at 503-579-1000 or check us out on the internet at clearfp.com. That's clear, C-L-E-A-R, F as in Frank, P as in Peter.com.
Perfect.
Thanks for joining us on Clear Money Talk.
See you next time.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetera Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Cetera does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetera representatives may offer these services through their independent outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59 and a half may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying subaccounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds asset allocation over the whole life of the fund. Often target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Cetera does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Bank certificate of deposits are insured by an agency of the federal government and offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with changes in market conditions. Clear Financial Partners is located at 15573 Bangui Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.